Good morning. It's Tuesday morning. It's the 13th. Here's what's on today's agenda. The Takaichi trade is definitely big in Japan this morning. Trump goes after, quotes, Iran's business partners. And Powell finds some friends in Washington, Tom.
None of that derailing the sentiment around the equity markets. Record highs in Asia, up 0.9% on the MSCI Asia Pacific. Record highs, of course, on Europe yesterday as well, alongside the US with the S&P 500 punching above those record highs again by the end of the close. Today, European futures also pointing to build on the gains of yesterday. Up 0.3%. It was basic resources that did a lot of the heavy lifting yesterday. That dynamic may change today. Oil prices are higher, but copper is down about 1%. S&P E-minis then, futures stateside after the record gains of yesterday, pointing a little lower by 0.1%. The countdown to the opening trade starts right now.
Good morning, everybody. It's just gone 7 o'clock here in London. This is the opening trade. We still have to do another day's conversation around the Fed. Still lots more to say about that. But a couple of themes from 2025 coming back into the markets to remind us that they're there. One of them is Japanese politics, long-end yields. The other is trade tensions. Let's go to Japanese politics first, shall we? Because Japan is back. Japan is open once again. Stocks are flying. The yen is weaker. Yields at the long end are higher. And all of this because we're seeing reports. We saw some on Friday and we see them today from Kyoto, the news agency, that Takaichi plans to call early elections, possibly holding those elections as early as February.
The moves in the Nikkei are significant. 3% is the move, and then the yen weakening, to your point. The sequencing then, in terms of what we could be looking at, according to the reporting. So, according to the reporting, we could see the lower house of parliament, a plan to dissolve the lower house of parliament. That could be announced on January the 23rd, which is the start of the next parliamentary session. And then we could be looking at a vote in Japan on February the 8th or the 15th. This is a relatively new Japanese Prime Minister, of course, took over the post in October, trying to capitalise on her high opinion polls, about 70% in terms of how she's polling. Hawkish on foreign policy, but of course it's the response in terms of fiscal stimulus.
Let's park the politics for a moment and just think about the market response and just kind of talk about what is going on here. The yen is getting crushed. At some point, the BOJ is going to have to respond. OK, so do we get accelerated rate hikes coming through from the BOJ? And if so, what are the implications of that? Are we going to see maybe the first signs of that showing up in Bund auctions today? Are we going to start seeing maybe less demand coming through from treasuries? What are the ripple effects of a weaker yen, a sharply elevated Japanese equity market and a bond market that really is important?
Well, I wonder what the bond markets are thinking about that question, because we don't see much movement at the short end at all, really. Not reflecting any sense of urgency necessarily around the BOJ. And the BOJ has not been urgent when it comes to delivering those rate increases. It's definitely at the long end where the fiscal has been the focus. And that's where we're seeing.
And that's where the selling pressure is, with the yields at 3.3, close to 3.5%. I don't think we've seen that level before. That's a record high in terms of yields on the long end for Japanese debt.
There's a story floating around this morning talking about the fact that Japanese investors have been sellers of UK gilts. They're concerned about what is happening in this market, but there's also the yield story back at home. There's the story, you're going to start to see European government bond auctions potentially being impacted by this.
That's the global story for Japan.
How does this change the global narrative, and does it have an impact? Does it reinforce some of the problems we're seeing in other markets, the UK, what's happening in Europe, what happens in the United States? Is this a reinforcing factor that accelerates the narratives elsewhere?
We'll once again ask that question in 27 minutes then when we get the open of European bond markets. Shall we talk about tariffs?
If we must. Again, tariffs. The Supreme Court ruling comes tomorrow, I think.
Maybe.
So maybe we'll get something on that. So that tariff narrative is in the background as well. So Trump wants to raise 25% tariffs on business partners of Iran. OK, great. So who are the business partners of Iran? China, India, Pakistan, the UAE, countries like this. OK, great. But those countries already have tariffs on them. And particularly China, it's really important that actually the truce is maintained between China and the United States that was established last October. So are these 25% on top of the 30% tariffs that China currently has, or they just kind of absorbed by those tariffs?
Well, we don't have the details, do we? Because this was announced on social media. He said they're effective immediately, but there isn't any detail as to how they are implemented. I mean, a lot of our reporting seems to be assuming that they get piled on top of the existing ones. And a reminder, we're already at 50% on India and 30% on China. That was as a result of that October deal between the US and China, which is still fragile, as you say. You know, that could still come back to be a theme.
So is the tariff risk back, potentially, for this Trump administration? Interestingly, he's meant to be going, President Trump, to China in April of this year to lock in that deal, that agreement, which is now looking very fragile. So we'll see if that changes the narrative in terms of the US-China trade tensions
and
as
China
well.
responding, because clearly they are the biggest consumer, not necessarily officially, but the biggest consumer of Iran's oil. And China is saying that they will protect their rights and their interests. Tariff wars have no winners. This according to the briefing coming out from China right now. China saying that these lines about Trump's tariff vows.
They don't know either. That's the problem, is the Chinese are responding to something that they have a complete lack of clarity on because policy is announced on social media and there's no details.
How the Fed weighs up tariffs and inflation. We're going to get CPI, of course, out later today. That's the big print. It's expected. Bloomberg Economics says it should be cleaner, though they don't think it's going to be completely clean. Bloomberg Economics, in terms of the CPI print that comes out of the US later today, but certainly cleaner than the print that we got in November, 2.7% or thereabouts on a headline basis. But then again, we continue, of course, so that's a fact of the Fed. But really, what the Fed's attention is drawn to is the response, of course, to this DOJ probe. Really interesting reporting from Axios. The Treasury Secretary Scott Bessent apparently had not been looped in, had warned President Trump.
Believe that if you will. Okay.
Apparently warned President Trump that this would be messy.
The administration's running away from this as fast as it can because it clearly has realised that it has maybe overstepped. And as a result of which, anybody that wasn't directly involved is like, I don't know, nothing to do with me.
Was this a relatively junior member of the Trump administration, Jeanine Pirro, leading up that DC office, trying to win praise and attention from President Trump, or is this an official who has a real case to be made? The markets seem to have gone for the former rather than the latter, and certainly the senior Republicans as well, landing on the former argument versus the latter.
We really saw hardly any market move by the end of the day yesterday.
I don't know how you price it. What do you do with this?
Well, as we said yesterday, on the one hand, there was the clampdown on the Fed, and on the other there was the pushback, and so the two were in tension with each other right from the start. So that one of the reasons why we didn't see a huge amount of market reaction. To your point about who knew what when and who did what and who's following whose orders, John Authers has a great piece comparing President Trump to Henry II, which I won't pretend to be an expert on, but having followers that follow you very, very well to the end seems to be the conclusion that John Authers comes to.
Yes, King Canute, waves. It's a great piece.
All of that gets a feature. Definitely worth a read. Let's tell you what's coming up on the programme in terms of the guests we'll be speaking to. Peter Kinsella will be with us. UBP, Head of Investment Services, will be with us. There was weakness in the dollar. We'll talk about FX. This all in connection with the Fed conversation. How much of that do we need to put front and centre this morning? Laureline Renaud-Chatelain will be with us. Pictet Wealth Management, Senior Fixed Income Strategist. Another chance to explore the fixed income impact around that Fed conversation, but also Japan. What is happening in Japan, the long end there. Henry Allen will be with us, Deutsche Bank research macro strategist, a great voice to have at the start of the European Trading Day. And we'll also be speaking to Michael Zizas, Morgan Stanley Deputy Head of Global Research, who I think very useful for us, has a background in studying political economy and history, which I think is extremely useful in today's economy.
Well placed to answer some questions when it comes to Fed independence, tariffs, and these markets. So that is a conversation we look forward to as well. Here's the daybook then for you today. 12:30 p.m. UK time. Marine Le Pen, of course, her appeal trial will be starting in France. So we monitor that, of course, potential implications for when President Macron steps down, but we'll watch the outcome. It could be a long running. 1:30 p.m. UK time as well. We're going to get the US inflation data. That's at 1:30 p.m. Then, of course, in terms of the earnings story, the focus switches to JPMorgan coming out with their earnings later. Delta Airlines in that space. Those earnings will be broken, of course, across the Bloomberg terminal with context given. And we will be hearing from more Fed speakers. The Fed's Barkin, Masalam speaking, and President Trump's going to be getting that briefing on Iran options. He has taken that move on 25% tariffs to those who trade with Iran, but we potentially could get another response. He's going to get that briefing.
What else do you need to know this Tuesday morning? Let's talk about that. We're going to start with news for iPhone users. Alphabet's Google has confirmed that it has entered a multi-year deal with Apple to power the iPhone maker's artificial intelligence technology, which includes the Siri voice assistant. Bloomberg reported late last year that the two companies were finalising such a deal, with Apple planning to pay around $1 billion a year for the privilege. UBS Chief Executive Sergio Ermotti apparently plans to step down in April of next year. This, according to a report in the Financial Times. The Swiss Lenders Board has not, however, finalised the timeline for Ermotti's exit, according to the paper. Ermotti has previously hinted that his current stint leading the bank could stretch into 2027, but he has tied his departure with completing the takeover of Credit Suisse. And Orsted shares are surging pre-market. This after a US judge has ruled that the firm can resume building a wind farm off the coast of Rhode Island, while it challenges an order from the Trump administration to stop all work. It marks a major win for the Danish energy giants in an ongoing fight with Washington. So it looks like that stock is going to be higher again. But in some ways you can plug the Orsted story into what else is happening. Pushback against Trump. Is Trump reaching the limits of kind of what is possible? You're certainly seeing maybe that around the Fed. The Orsted story kind of speaks to that as well. There are others as well. What does this tell us about kind of what Trump's powers are going into the midterms? And
where they are limited, to your point, yes. I mean, maybe you explore this instance by instance. Maybe the credit card conversation is separate from the asset managers conversation, it's separate from the housing market conversation. But with an administration that is intervening in all of these markets right now, interesting to see where you get that kind of pushback.
Yeah, and politically as well, we've seen more instances of Republicans starting to side with the Democrats, whether it's on healthcare, for example, which is seen as a bit of a blow to his authority. And of course, many senior Republicans putting the wagons around the Fed.
It's important because if you think about institutions matter. Institutions matter to international investors. If institutions don't work, the credibility of a country starts to crumble, and people maybe invest less in it. The UK is maybe an example of this, dare I say.
Well, the UK has been described at points as being close to an emerging market. That statement from previous Fed officials and Treasury officials regarding the DOJ probe or investigation of the Fed, this is how, I'm quoting, this is how monetary policy is made in emerging markets with weak institutions, to your point, with highly negative consequences, of course, for inflation and the functioning of their economies. Signed by Ben Bernanke, Janet Yellen and others. 3
former Fed chairs, 4 Treasury secretaries from different parties, nominated by different parties, importantly, as well. 12 minutes past 7 here in London. Coming up on the programme, we'll focus on financial services through the morning, as there's plenty of news there. Citi and BlackRock are both said to be preparing major job cuts as the banks and financial services providers look to trim costs. Plus, we will check on Airbus shares at the open, as the company expects aircraft engines to remain in tight supply this year. Up next, markets continue to weigh risks to Fed independence amid that DOJ probe, which we're talking about once again. We will discuss that, of course. If you have any questions for our guests, please get in touch. IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
Good morning. It's the 13th. Welcome to the show. We're 43 minutes away from the market open. This is the kind of picture that we're looking at, fairly flat. But look, many of the markets in Europe are going to go higher this morning. It's going to be interesting to see which single stocks move as well. Keep an eye on Orsted. That's going to be certainly one to watch out for. Today, we're kind of dealing with, is it day 2 or day 3 of what is happening around the Fed? And what happened over the weekend has rippled into this week and continues to ripple into this week. The Trump administration's against Fed Chair Jay Powell, certainly triggering a backlash that could derail the White House's plans to tighten controls over the central bank. That's the kind of growing consensus. Fed officials, US senators of both sides of the aisle pushing back on the investigation and have reiterated the importance of an independent central bank.
Throughout that time, he has been completely dedicated and committed to the Federal Reserve's mission to support the American people. And throughout that time, he's proven himself to be a man of impeccable integrity and a man who has been calmly leading the Federal Reserve through times of heightened uncertainty and led us very effectively.
That's what this probe is. It's a pretext. It's a way to try to knock the legs out from Jerome Powell. I'm no Jerome Powell supporter, but I am a supporter of Fed independence. And the weaponization of the Department of Justice is fundamentally wrong.
President of the New York Fed, the most senior Democrats on the Senate Banking Committee, giving their views on what is happening around this issue. Senior editor Alistair Bull joins us now to talk about what happens next and what the administration is going to do next. Alistair, it seems as if maybe there has been some overreach, and we're starting to see senators, we're starting to see even senior members of the administration backing away from this story as quickly as they can. Is it over, or does it continue? Is this a story that the markets can now ignore, or is this something that is going to continue to rumble on?
I think it rumbles on until there's some clarification from the White House of how they view this investigation. Or the DOJ itself announces that it's sort of got the information it sought and isn't going to take it any further. While the threat of an investigation hangs over the Federal Reserve, the narrative about the Trump administration being reckless with the reputation and integrity of the central bank and US monetary policy is going to be out there and is going to be undermining confidence. And I mean, so far, the market reaction was not good. It's been somewhat negative, but it has been totally disastrous. But it's a little hard to take comfort from that if you are the White House, because it may reflect investors thinking, well, the Trump administration is going to see that this was an own goal. It's going to sense the pushback from its own party. You've had a number of senior Republican senators saying this is bad, we're not going to stand for it. Tom Tillis, a critical member of the Senate Banking Committee, has come out frankly, so I'm going to block any nomination. So as that sort of message percolates, I mean, I think the sense is that they'll find a way, they'll find an off-ramp. And you mentioned this before, that the White House seems to be trying to distance itself a little bit from this. There's an idea that the DOJ was acting without coordinating. There's reporting that the Treasury Secretary Scott Bessent wasn't in the loop, has reacted in a very sort of angry fashion or frustrated fashion, reaching out to the president and warning him on Sunday that this was going to be a mess. And I mean, from Bessent's point of view, you could understand his frustration, because he spent months trying to prepare financial markets for the transition from Powell to the next Fed chair. And yeah.
Thank you very much, Alistair. Thanks for the analysis. We appreciate it. Alistair Bull, Bloomberg's senior editor, with the latest on the Fed conversation. Let's get more on how the markets will perceive this. The probe into Fed Chair Jerome Powell and the market reaction. Peter Kinsella is with us, Head of Investment Services UK at UBP. Peter, good morning to you. So it seems that yesterday we were not buying the dollar. Today the dollar is on pause, as this story maybe is on pause. So you're not buying the dollar, not buying the yen for other reasons, which we can talk about shortly. So where is the currency of choice right now if it's not the dollar?
Well, I think it's interesting to look at what we saw yesterday. Really, was that the dollar weakened a little bit, but US yields inched higher. It wasn't really a huge move by any means. What did move was gold, and I think gold is telling you really that investors are quite worried about the long-term trajectory, fiscal deficits, debt, etc. And this kind of question of, this creeping sort of, I would say, threat to the Fed's independence, and more broadly to the independence of central banks everywhere. Because if it starts with the Fed, where does it end? So I think gold is really telling you what markets are worried about at present, longer term. And that's really where the effects are seen.
Do you feel this is a story on hold now? To Guy's point, do we just park it for the moment?
I think it's probably likely. I think the issue is that it's now a known issue. We have to see when Powell's going to speak to the DOJ, and so the issue's out in the open. We'll have to see what the response is. Quite equally, the DOJ could turn around and say, okay, yeah, we've gotten all the information we need, and there's no case to be answered here. That of itself isn't necessarily a reason to buy the dollar, right? Okay, you may say it's holding the institutional integrity of the Fed. However, I think that the bigger picture here is that you are seeing the Trump administration try every means at its disposal to get rid of Jerome Powell, and that's a worry.
So you don't think, Peter, good morning, you don't think ultimately at the end of this there could be a scenario where the Fed comes out stronger on the back of this because of that institutional support they're getting from senior Republicans and others, and the stance that they've taken? That isn't a scenario for these markets. You wouldn't price that.
I think really what we're likely to see with the Fed over the longer term, right, is that I suspect the Trump administration or the MAGA movement will do to the Fed what successive Republican administrations have done to the Supreme Court. They'll pack it with their supporters who eventually toe the line, right? And And I think that's a longer-term trajectory where we're going here. So it's a bit premature to call the all clear.
So you short the long end of the Treasury curve on that?
You would, yeah. But I mean, there are good reasons to do that anyway, right, given what you're seeing on the fiscal side of things in the States. So I'm not sure it's really something that you can trade in the sense of being an immediate tradable issue, but that's the worry I would say investors have.
What's happening in Japan? How do I trade it? Is it the right trade? Is the Takaichi trade the right trade?
Well, it depends whether you're buying the Japanese equities or shorting the yen. If we speak about the yen, I think it's pretty clear the BOJ is highly unlikely to raise rates in the short term. Historically, they've never really sort of done a lot coming into election periods.
Yep.
And I think that'll be the case.
At some point, doesn't it? How much cheaper does the yen have to get before the BOJ has? Even the politicians are going to start getting nervous. In fact, they were nervous a long time ago about the fact that the yen just keeps cheapening. How do you stop the yen cheapening?
Well, they intervene very clearly.
Okay,
right?
but intervening doesn't really work in the long run.
No.
So how do you stop the yen weakening?
So I think for the BOJ, ideally they would have to raise rates, but they've got to raise rates at a level towards which the real inflation-adjusted interest rate would be flat or positive.
Okay.
And we're still deeply negative.
So how far away is that?
Well, basically, you're going to have to get to 2.5% at the front end for the BOJ, which I think is highly unlikely. And let's not forget, the BOJ is still undertaking QQE.
So the yen stays weak?
It's hard to see what the idiosyncratic trigger is for yen appreciation.
Okay.
And I mean, we've got yen yields at the long end up by 10 basis points. Very unmoved, maybe to the point about the BOJ, little expectation of a hike, very unmoved at the short end, but at the long end. And you're talking about rising at the long end for US Treasuries as well, yields this is, because of other concerns around the Fed. This is all adding up to long-end yields being back in focus. I mean, they were last year and still very much in focus this year.
Very much so. And I think if we look at the JGB curve, the long end of the curve has tended to lag what we've seen in the US and Europe and elsewhere. So that, I suspect, is because of A, market expectation, B, QQE ongoing. And so as a result, it's not really probably where it should be. It should probably be higher. And certainly given the fiscal trajectory we have in Japan, you could argue that, we should see, 30-year JGBs towards sort of 3.6, even 4. However, it's unlikely to get there in the short term. And that's one of the reasons why I suspect sort of the lifers in Japan, they're buying a bit at the long end of the curve, but they're not jumping in.
So what's the level then? Because we were talking about the global ramifications of the Japan trade. What is the level that causes that repatriation?
I would say if you get towards 4-ish, that would definitely be a significant point. But it may well be less a repatriation trade and more just that they actually export less capital towards other markets, right? And they just keep a domestic bias.
But we're in a situation where the US is running a fiscal deficit that is normally associated with either a massive recession or war, and questions are being asked about funding that going forward. You've got the Japanese, who have been basically huge providers of capital to the global economy, the US economy, for decades. How close are we to the point at which that could stop?
Well, you should be at it already, because when we look at JGBs and you look at them versus treasuries on a hedged basis, you're getting better yields in JGBs, right? So you should actually be there already. But I think, just from a capital allocation perspective, you don't want all your eggs in one basket, be that as a Japanese life or elsewhere. But look, I think that the key point is that as we edge higher, that reduces the inclination to put capital elsewhere.
Peter, thank you very much indeed. Peter Kinsella, Head of Investment Services at UBP. Coming up, we're going to head to Tokyo as the speculation mounts, of course, about Prime Minister Sanae Takaichi maybe calling a snap election. Stay with us. This is Bloomberg.
Welcome back. This is the opening trade. It is Tuesday morning, 30 minutes until the start of cash equity trading here in Europe. The futures picture then, let's pull that up for you. It looks flat, mixed, really. FTSE futures could be laggards today. We are expecting a little bit of a bounce. And if you look at what the US did yesterday after Europe closed, there was room for a little bit more, or there is room for a little bit more appreciation perhaps here in Europe just to keep up with that story. So maybe that's what we're in for. We'll watch Orsted, we'll watch the retailers in the UK as well on the back of those BRC numbers that we had out earlier. Guy, the bond market story to the fore. for?
The bond market opens in Europe, a little bit of a sell-off, not a huge one, but a little bit of a sell-off underway right now. As you can see, yields are a little bit higher. You're seeing a similar story stateside as well, where you've got a US 10-year trading at 419, 420, top end of the recent range, but not breaking out of that recent range. The real story is in Japan, which is on my Bloomberg terminal, there's a little sort of red box around Japan, which tells me I should be paying attention to it.
The Nikkei up 3.1%. Of course, Japanese yields up as well. Japanese bonds selling off and the yen under pressure and Japanese equities soaring in the session up more than 3%. Speculation, of course, that Prime Minister Sanae Takaichi may soon call a snap election. For more on this, let's bring in Brian Fowler, our senior editor in Tokyo. Brian, there's been a lot of reporting out in the last few hours. What do we know about the likelihood of a snap election, the rationale, and how the markets are adjusting?
Yeah, so let's start with what's at stake here. So right now, the ruling coalition's majority in the lower house is exactly one seat. That's 233 out of 465. So it could hardly be more fragile than it is. And Takaichi is looking to seize the moment and try to build a mandate for her agenda. And on the one hand, maybe for her, she thinks the timing is right. Her own support ratings since she took office in October have been very high by historical standards, generally in the 70% range, as high as 80% in some polls. So she's looking very strong right now, and she has a lot of popular support. The same can't really be said for her party, the LDP. A lot of voters still resent the fact that the LDP had a political funding scandal a couple of years back, and the LDP has not fared well in the last two national elections. So there's that. The other thing is that the ruling coalition makeup has changed this time around. For decades, the LDP was teamed up with the Komeito, which was famous for having a very well-organized grassroots organization to get the vote out. The LDP is now with the Japan Innovation Party, very strong in the Osaka region, but not very strong anywhere outside that area. So it kind of remains to be seen what the coalition can do across the country. So there are definitely some risks that come along with this.
Yes, and one of the other risks, Brian, I was thinking of, I was reminded of, well, in other geographies where politicians have been tempted by the polls to take risks, to try and increase their power, and actually have found that the opposite has happened. And I know in recent Japanese history that has happened in the past. So this is not risk-free for Takaichi.
Yeah, that's absolutely right. So her predecessor, Ishiba, took office with fairly high ratings as well, and he called an election very quickly, and that was a debacle for the LDP. It lost its majority in the lower house in that election, and then the following year lost its majority in the upper house. So she's definitely taking a risk from that standpoint. I think she's hoping maybe at this point to catch the opposition off guard a little bit right now. The timing looks to be rather fast. So media reports are saying she will dissolve the parliament on the 23rd of January and then call an election for as soon as February 8th, maybe February 15th. But that doesn't give the opposition much time to get its strategies together. There's no way they can actually defeat the LDP as a single party. If they're going to do anything, they're going to have to organize some kind of coordinated effort. And it's probably a big ask for them at such a short timeline.
Yeah. You wonder whether the fight with China feeds into all of this as well. Certainly many aspects to watch on this story. Brian, thank you very much indeed for updating us. Brian Fowler joining us out of Tokyo. What impact do higher Japanese yields have in the rest of the world? How should you be playing the Japanese bond market? What is the picture here? Laureline Renaud-Chatelain, Senior Fixed Income Strategist at Pictet Wealth Management, joins us now. Laureline, good morning. What are the implications of higher Japanese yields?
Good morning. So indeed, what we have seen this morning is quite a rise in the long end. So one would say that global bond markets are often correlated. So there is always this fear that if we have sharper, higher yields in Japan, then it could trickle down to European yields, but also US yields. But honestly, so far what we have seen is really a movement more in the Japanese bond market because of this potential early election and the fact that that could unleash even more fiscal easing than what we have seen. And in this sense, also maybe trigger the BOJ to be more aggressive with its rate hiking cycle. So I would say that at this stage, it's very domestic. But obviously, we're watching the yen, and that could also have some impact maybe in the rest of the developed market, but that's not what we're seeing right now.
Do you think the yen, weakness in the yen, which is getting quite extreme now, could force the BOJ to act? We were talking about it before, seems maybe after the election, but is that coming?
Yeah, so far what we have heard rather is maybe that the Ministry of Finance could act by obviously intervening on the FX market. So at this stage, we will rather look for that, and that could also maybe come, because we know that they don't like when the yen weakens too sharply in a steep move, I would say. So that would be technically a moment where they could start to intervene, and that could calm a bit maybe the market. And then regarding the BOJ, I would tend to think that they would wait to see the result of the election and act accordingly. And obviously, if we have more fiscal easing, they could be more aggressive with the rate hiking cycle, and that's what the market is starting to price in.
Good morning to you, Laureline. Are we talking about higher yields at the long end of the Japanese curve and higher yields at the long end of the Treasury curve as a result of the Fed independence conversation? Do you think both of those come to pass, and what's the impact on your strategy of that?
Yeah, so it's interesting because we actually underweight both on US Treasuries and on Japanese government bonds. But I would tend to say that what's happening with the Fed, as you could see yesterday, had first an impact on the long end. I agree with you, we had slight steepening, but that calmed down because what came after that was news from congressmen really opposing all this discussion about the Fed probe and basically saying they are not going to be ready to vote and accept a new Fed chair until this is resolved. And that's a strong statement for the Fed independence. So I guess the market took comfort with that. Whereas regarding Japan, we are obviously in the unknown because we don't know what the results are, because we know that Takaichi has strong polling, but that's not that clear for her party. So it's not sure that she will have such a strong governing coalition after the new elections.
The politics is clearly something we watch very closely when it comes to the Fed, Laureline, but we're also watching the data. Are you expecting to see 2 rate cuts from the Fed this year? And if so, what's the reason? Because we've seen the unemployment rate coming down, the GDP, AI, CapEx, investment story seems to be strong by some accounts. So what's the reason for rate cut expectations?
Yeah, so on our side, the expectation was really linked to the consumer. So I think you've heard a lot about this K-shaped economy, the fact that the low-end consumer is suffering much more. And then what we would have seen in the data would be lower consumption. So that was true for the first half of last year, but then there was some piling into goods because of the tariff. So that has been rather distorted. So obviously we're watching retail sales this week. And then we will still watch the employment reports coming in the coming months, obviously, because that's key. If we see that the labor market is not adding as much job, then it means that some lower-end consumer have difficulties finding jobs and then consuming as they should, and that's a big engine of the U.S. economy.
Laureline, good morning. Tom here. What kind of number would, from the inflation print later today out of the US, the CPI print, would lead you to fade those expectations of 2 additional cuts from the Fed this year?
I guess 0.3% month on month is the key number. So as long as we stay below or close to that, I guess the Fed has the leeway to keep cutting, because they expect some tariff pass-through, and we know that the effect is going to be stronger in the coming months, right? Now, if that goes much higher than that, then it can bring back this fear that maybe it becomes more entrenched in the economy, also with regard to inflation expectation from consumers. So it's not something we've seen. We're watching the NFIB as well for the small business survey, but also the consumer surveys. And what you see is that they are not that confident. Nobody is that confident for the strength of the US economy.
Okay, and equally a lack of confidence in terms of the trajectory around inflation then, presumably. When do you expect to get to that 2% target for the Fed?
So in our scenario, we had it for the second half of the year, towards Q4. We'll see that could happen quicker, to be honest, if the oil price keeps sliding towards $50 the barrel, which is in our scenario for the second half of the year. Now, what's happening with Venezuela is distorting a bit this demand and supply picture. But that's key as well in terms of inflation expectation. And what we have seen, I think, is interesting. When you look at inflation expectation from the market, actually on the short end of the curve, it's quite low. So we're running between around 2.4, 2.3%. So it's not telling you inflation back to 3% for a long time.
Laureline, what do you think is most mispriced at the moment? If a client asks you a question, kind of what I think is off? Is it Bank of England pricing? Is it kind of what's happening with the Swiss National Bank? Where do you think the most obvious misprices are right now that you can take advantage of?
Yeah, I think on our side I would say for the government bond market is more this expectation that basically it's all bearish on the long end. So nobody wants to touch the long end of the curve. You see that there is much more appetite in the belly of the curve. But when you look at the absolute yields level, they're very attractive. Real yields are very attractive. And when you think about the GGB yields, when you convert that you hedge that into dollar, it's also very attractive. So at one point, maybe if there is a trigger where market participants feel more comfortable either with the inflation outlook or also the fiscal outlook, then there could be a switch from maybe equities where we have very expensive valuation into the long end of the curve where we cannot say that we have expensive valuations.
And Laureline, do you think that the corporate bond market is mispriced, or does it look to be pricing things accurately to you? I mean, you talk in your notes about European high yield spreads and comparing them to the time in 2018 when the ECB was doing QE. Does it make sense for spreads or yields to be in the same place as where they were at that period?
Yeah, I fully agree with you. We are in a different world. We're in a world where we have a lot more uncertainty economically. And as you said, we don't have the support from the ECB. But I guess with regards to Euro high yield, there is this expectation of much stronger growth in Europe this year. And then when you look at the short end of the Euro high yield curve, it looks very appealing because you get yields that are obviously much higher than in IG without taking too much duration risk. But to your point, I think when we look at default data, it's still at elevated levels. So spreads where they are now, for example, on Euro high yield, it's close to 260 basis points. It's not compensating you for the default risk in our view. So that's why on our side, we have more of a very selective approach on high yields, both in US and in Euro, and very selective with the names we're choosing.
Yeah. You get 5% in UK 30s. Just going to point that one out. Laureline, thank you very much indeed. Laureline Renaud-Chatelain, Senior Fixed Income Strategist, joining us from Pictet Management. Coming up, don't fight the Fed.
Will it backfire on the Trump administration?
It could, because be careful what you wish for, right, as the old saying goes. If you want to run the economy hot and inflation runs out of control, that's a problem for the administration.
More on the rising opposition to the DOJ's investigation into Chair Jay Powell. That's next. This is Bloomberg.
By reducing the target range for the federal funds rate by a cumulative 75 basis points last year, the FOMC has moved the modestly restrictive stance of monetary policy closer to neutral. Monetary policy is now well positioned to support the stabilization of the labor market and the return of inflation to the FOMC's longer-run goal of 2%.
That was New York Fed President John Williams speaking at the Council on Foreign Relations. We also heard from the former Philadelphia Fed President Patrick Harker, who gave his take on the current DOJ probe of the Fed.
When you talk to members of Congress on both sides of the aisle, they understand this. They may have different rhetoric out in public, but you talk to them one-on-one, they understand how critical the Federal Reserve is, and they are going to push back. That's where I'm an optimist. I don't think they'll let this happen.
Okay, on the pushback around this DOJ probe, which raises all sorts of questions. Does the Fed come out with more institutional independence, or is that independence still being eroded? And what does it mean for President Trump's potential picks to replace Fed Chair Jerome Powell when he steps down in May from the Fed Chair position, if not the governor position?
And how do markets respond to all of those questions? Let's bring in Bloomberg Markets Live, Skylar Montgomery-Koenig, who is with us for 3 minutes on the markets. Skylar, so this time yesterday we talked about limited reaction in markets to the Fed narrative, as dramatic as it was. By the end of the day in the States, we'd seen almost no reaction, really, net to what was happening. Is this a story on pause now because of the substantial pushback that we've seen from parts of the administration, or from Congress and from senators?
I mean, I think with this administration, you can never say something is completely gone in terms of we could get another headline. But in terms of the news that we've had so far, I think it's largely been digested by the market as no different from other threats to the Fed's credibility that we've had previously that proved to be not standing the test of time in terms of not having a long-term market impact, not deterring people from buying U.S. assets, certainly. And I think the clear sign you can see of that is the front end of the yield curve in terms of if you were seriously considering threats to the Fed's independence that forced them to cut more aggressively, you'd expect that to be priced a little bit in the front end, but it's not at all. You didn't see movement in where those cuts were priced. So I think it's kind of on to the next thing, although, you know, we could certainly get more headlines around this, and we probably will.
And the next thing being more inflation or less inflation.
Yes. So we'll get the inflation data today. The way I'm thinking about it is there's a relatively high bar for it to be dovish. And I'll give you two reasons for that. The first is the kind of shift we've seen in the emphasis on the Fed's mandate in terms of inflation's kind of been pushed to the back burner. Powell's talked about it being transitory. It's not something that's been considered as strongly. So it's something that's not mattering as much. And I think, too, because we got employment data last week, it did kind of skew more to the strong side. Yes, it was a bit mixed in terms of non-farm payrolls coming in a bit weaker than expectations, but the important bit was unemployment ticked down. So that's a positive sign in terms of you can't price in a lot of dovishness under that labour market context.
I thought equity markets just priced it. I thought equity markets only did dovishness. Isn't that kind of...
Well, they either do growth is positive, which is great for equities because earnings are positive, or you do, oh no, it's a little bit soft in the data and that means we can get some dovishness, and that's great because your rates get reevaluated.
When does, Skylar, what are you watching for when it comes to Japan that could make Japan not just a Japan story but a global story?
Yeah, I think there's a couple things in terms of the long end yield. If that kind of continues to creep higher, I think because that's acted as a lower bound on where G10 yields are. If that moves up, it pushes everything else up as well. And I'm very seriously considering Japanese intervention as well from an FX perspective. So what you've seen happening right now...
Is that at 160 level, 161?
Yeah, well, this is it. There's this talk around you can't have Japanese intervention in the FX market because that would weaken the equity market, and you don't want that if you are actually having an election. But it's also not good to have FX weakness because it's essentially a consumption tax. So it's not a good thing from that perspective either. So I think it's something you need to watch, certainly, as you head to those psychologically important levels. As you're mentioning, 160, you've been disconnected from fundamentals for a while, and generally the precursor is verbal intervention, and we've had some of that already. Even this morning, there's been comments about it being disconnected. So I think certainly something to watch and not ignore just because you're worried about the equity market.
Just quick question. Staples went up yesterday in America. What's going on? This should be recessionary indicators, yet Walmart was flying. Is it because Trump's trying to help the bottom of the K, or is it because there's a recession coming?
I mean, I think it would be more because Trump's trying to help the bottom of the K. We've had big fiscal headlines out there, so that's what I'd point to. But also it could just be, you have weird days where positioning kind of moves things, and it's a bad reason for something. But, like, if you don't have the fundamental reason, then it's not fair to kind of
I'm just looking for a narrative.
Guy continued to prod the health of the US economy with big question marks. Bloomberg Markets Live, Skylar Montgomery-Koenig, thank you very much indeed, walking us through some of the key drivers globally across these asset prices. Let's bring in right now with a lens on some of the individual movers today, potentially, Chloe Mallet, with a focus first on Orsted. Chloe.
Good morning, Tom. Indeed, it could be a good day for Orsted today after a US judge ruled that it could resume work on the wind project off the coast of Rhode Island, which is a project that the Trump administration had suspended. So now this means that Orsted can continue building this wind farm, which is about 90% complete already, while that legal fight with the administration continues. And this is seen as quite the big win for that wind industry, for that renewable energy industry against the Trump administration, which of course has been trying to put a stop to some of those clean energy projects. And so we could see Orsted shares moving higher, but also some of those other peers within that renewable energy space also following Orsted higher on the back of that. Moving on to Airbus, which could be a little bit weaker today after saying that it expects engine shortages to continue in 2026. So that would mean that the supply chain issues that have really been plaguing the industry and plagued the industry all throughout 2025 might also be at top of the agenda for this year as well. And so we could see maybe some weakness in those shares. This is important to consider within the context of Boeing shares as well, obviously the closest rival. And as we can see, that performance closing in on the Airbus performance there. And Boeing is also dealing with those same supply chain issues, but it is benefiting from a little bit of political backing from Trump as well. Okay, and finally, retailers could also be on the move today after some new data, and so we could be keeping an eye on both clothing retailers and grocery retailers this morning on the back of this.
A very good point, Chloe. Important one to watch. We will do that. Chloe Melly with a rundown of the stocks we're watching this morning. I'll add to that list, Diageo, the drinks maker, has a 63% stake in a Shanghai-listed business, and our reporting suggests it's considering what to do with that stake. The whole business is worth $2.7 billion, so we'll watch that one at the open. But futures are flat to positive. US futures, though, looking a little more gloomy. Not much, but a little.
It was amazing they finished up yesterday.
Yeah, it was.
But it was amazing they finished up yesterday on staples buying, which is just, it's slightly odd.
Makes a change from the AI story. Anyway.
It does, yeah.
Yeah, well, at least for now. We'll get Alphabet and Gemini and that story in. And
basically, the US stock market was prepping yesterday.
Excellent.
The opening trade and futures, of course, pointing higher. We'll bring you the opening trade shortly. Stay with us. This is Bloomberg.
Good morning. I should probably explain my joke before the break on the fact that the US market was prepping yesterday. I don't mean it was buying knife scarves and kind of quilted coats, that kind of thing. No. What it was maybe doing was buying tin food. So effectively, the US equity market bought tin food yesterday. It bulked up on staples. That was the trade. Slightly odd in so many ways if you think about what that would signal. It would signal maybe caution ahead. But we still went up. On a day when we were seriously challenging Fed independence, the equity market went up and finished all-time highs again. But that doesn't seem to be a story anymore, Tom.
Oh, that's in food trade. So yes, look, the equity market is not for one. This rally is not one for being derailed. Yes, you have the FTSE 100 flagged flat, but that is a bit of an idiosyncratic story around the softness around the retail trade here. But European markets, to your point, record highs yesterday, looking to build on that today, up 0.3% on the future story. We talked about the FTSE 100, the DAX pointed gains of around 49 points. Record highs as well for the S&P 500 yesterday. But today, European equities at least moderately on the front foot. Anna.
Let's talk about some of the stocks that could be in focus then, Tom, and we've got Orsted certainly up there. After the close yesterday, we learned that Orsted has won a ruling in the US to resume one of its US wind projects that have been halted by the Trump administration. This is just off the coast of Rhode Island. It's challenging, of course, the government's stop work order, so that challenge continues, but meanwhile, they can go back to work on it. Diageo is in focus. The drinks business listed in London is said to be considering, or it's considering, according to our reporting, options for its Chinese assets, including potential divestment. Or maybe, and it's trying to streamline its portfolio. That's the overall aim here. And UK retailers guide could be in focus. BRC numbers looking pretty gloomy for the fourth consecutive month.
Maybe we in the UK do need to buy tin food. Anyway, let's talk about this equity market as it's about to start. Let's take a look at what is happening here. We are looking at a market that is fairly flat. FTSE 100's out of the gate, up a little bit. The futures were a little while ago pointing it's slightly negative, but I think it's a very fine, kind of finely balanced story there. Let's see what the retailers do today. Yesterday it was actually the banking narrative which drove the FTSE 100. Stock 600 up by 0.1%. Not much movement there. We'll wait and see some of the other markets open. Keep an eye on the luxury sector. It was Laura Piana, I think, was out with results. That could ripple into the luxury sector today, but it's hard to see that there was much in it that would change anything. CAC 40 down by 0.1%. IBEX is up by 0.2%. I've got nothing at the index level to tell me kind of what's going on below the surface, anything useful anyway. Tom's here.
Oil prices are higher, so that's lifting energy. That's your top gainer across the sectors, Guy, right now. Top of the list, up 0.7%. You mentioned the banking story, of course. We have the earnings kicking off stateside. JPMorgan later today, 1:30 p.m. UK time. We'll break that number for you, of course, around then, at least, JPMorgan earnings. Banks, again, they gained yesterday, to your point, Guy, and up 0.4% so far in the session. Tech getting a bit of a lift, up 0.2. On the downside, the most softness, Anna, coming through. Construction materials down 0.6% so far. And then back to the index level, just moderately flatter on the FTSE 100, and the CAC current down at 0.2%, Anna.
Yeah, we're pretty evenly split, aren't we, from a sector perspective, about the sectors going up and the sectors going down. You're right that energy and banks are to the upside, insurance, construction and materials to the downside. But we are pretty evenly split. The overall move then in the stock 600 so far. 1 minute and 40 seconds into our session, we're up by 0.1%, not moving very far in a hurry.
It was Bruno Cucinelli. I mix up my luxury stocks. I said Laura Piana, I meant Bruno Cucinelli. Easy mistake to make.
For someone who spends so much time on Bond Street,
I was just waiting.
It's a shocking disappointment, falling on our estimations. We are seeing a bit of movement in some of the stocks that we flagged. So Diageo is up by 1.5%. That's interesting in London on talk of an asset sale over in China, the potential for an asset sale at least. And certainly using Next as a proxy for the UK retail space, non-food, we're not seeing a drop there on those BRC numbers, but we already heard from Next, didn't we, with their stock-specific update. That stock up by 0.3%, and Orsted not yet open, so still waiting for that one to respond.
Yeah, it does seem to be a bit of a read across from the Orsted story when we get that print from Vestas right now, which appears to be gaining pretty decently. In fact, I've just refreshed. Vestas up a little over 2%, so in terms of the read across on the Orsted story, and again, when we get the print from Orsted, we'll bring that to you. Again, on the FTSE 100, a little bit of softness for BAE Systems, so maybe defence under pressure after a couple of days' decent runs. Currently down 1.3%. What else is standing out to you, Guy?
Chocolate.
From fashion to chocolate.
I know.
You're bringing all the fun today, Guy Johnson.
Well, we've done the prepping thing, the tin cans. We want to move away from that. Linton Sprungley out with numbers this morning, and looks like the stock is responding fairly well to that. So the chocolate trade is on this morning. But also, is it open now?
Yes, it is. It's up by 5% on the back of that news out of the US.
That they can restart. They're 90% of the way through this project off Rhode Island.
While their legal challenge continues.
Yeah, so it looks like they've got a good chance of completing that within that time frame, potentially. So getting a lift on the back of that. Let's get more market analysis right now and bring in Henry Allen, Deutsche Bank research macro strategist. You're pretty bullish, despite the geopolitics, despite Fed independence risks, despite question marks about the resilience of the US economy. How are you thinking about what you're seeing right now to start the year and whether or not that confidence is being put to a test?
Well, it's certainly being put to the test if we look at the array of events, as you say, the geopolitics from Venezuela to Iran. We've now had a serious challenge to Fed independence. But despite all of that, yesterday again, the S&P 500 at another record high. So I think that resilient story very much remains. And if I look at the high-level backdrop for this year, I do think it's still pretty positive. We've still got the AI story with capital expenditures, productivity gains. We've got more certainty on the trade side. And actually, we've got a big fiscal impulse coming this year, both in Germany, where that stimulus is going to impact this year, and actually Q1, we're going to see a big fiscal impulse in the US from Trump's big, beautiful bill that was passed last year. So I think at the high-level backdrop, things are still pretty resilient looking forward.
Trade. You mentioned trade, because we have 25% tariffs apparently being announced. We don't have the details yet on countries that trade with Iran. Is tariff risk not back to the fore for this Trump administration?
I think it's definitely there, but actually, as I look to the year ahead, I think the risk is on the downside. One thing I've been struck by, even in the last 2 or 3 months, is that as affordability concerns, inflation concerns have risen up the agenda in the US, they have rode back a bit on some of the tariffs. So we've already seen tariff relief at the end of last year on prominent foodstuffs that consumers obviously see, like coffee and beef. Actually, on New Year's Eve, it was filtered out that they were postponing extra tariffs on upholstered furniture by another year. So again, items that consumers are purchasing that are quite obvious to them, particularly with the midterms coming up, so there's political incentive to keep inflation down. I think the risks at the tariff front are skewed on the downside. We've had the big increase last year. Actually, I think there's downside risk. And actually, the court case adds into that, because soon we're going to find out whether the Supreme Court might strike down the tariffs under the International Emergency Economic Powers Act. And although there are definitely alternatives the administration could pursue, even if they do strike those down, I could believe they take the opportunity to not do one-for-one replacements of that.
But how does that fit, good morning to you, Henry, how does that fit with news flow last night? President Trump saying, right, I'm putting another 25% on Iran's trading partners, which is, for example, India and China, where you already have tariffs at 50% or 30% in the case of China. And here's another 25% that he plans to put on top. That's a fragile relationship, certainly the US-China one. And it's already in focus this year because it'll need to be, that truce will need to be renewed. I suppose, does this just remind us that we maybe are not at the end of the story when it comes to trade tariffs?
Certainly, I think it's definitely a risk. But I think, firstly, we don't know the details as to whether that's additive or if that's separate. For instance, if a country already has a 50% tariff with the United States, is that 25% just incorporated into that? Is that actually an extra tariff on top? We don't know the details around that yet. And the other thing I'm conscious of, as we found out consistently last year, is Trump would often threaten additional tariffs. So, for example, shortly before he met with Xi in South Korea, he threatened additional tariffs of 100% extra on China that were actually never implemented. Trump often is used to throwing around these tariff threats in order to get his way in other policy areas. So I certainly wouldn't discount that that is a threat that he's leveraging in the short term that will then be dialed back.
So if the trade threat is fading and if the US looks a little less attractive given all the Fed independence conversation and we're spending a lot on infrastructure and defence here in Europe, there are a lot of people tell us that Europe is, the place to be and exciting. But then looking at a sort of more technical chart provided by colleagues today, the Stock 600 showing really strong momentum and actually could be defined as being overbought, the most overbought in 10 years by some measures. Does that sort of thing worry you, looking at Europe?
A little bit. I mean, European equities have been on a tremendous run recently. I mean, one thing I was struck by, actually, the DAX is now up 10 days in a row. And futures, as Tom was showing earlier, are also pointing positive today. If we get an 11th gain for the DAX today, that's the longest run of consecutive gains since 2014. So a pretty striking run that we're not used to seeing. It's not usual to get kind of day after day after day all-time highs. So if we do get a little bit of a pullback from that, that doesn't alarm me. One thing I'm struck by, we see in the US context as well, that we get these kind of 1 or 2% sell-offs, and the headlines are very much talking about this as though, is the AI bubble finally bursting, when actually these are fairly moderate sell-offs by historic comparison. I think the same applies to Europe as well, that you're going to get, not every day is going to be an all-time high. You're going to get these periodic pullbacks, and that shouldn't in and of itself alarm us.
You said many interesting things. Let me pick up on one of them. You said that Trump may not replace tariffs one for one. What we've seen over the last few days is Trump clearly is worried about the bottom end of the K. He's worried about the midterms, and he's going to try and use all the tools in his toolbox to try and solve the affordability crisis. Does that include tariffs? Is this an opportunity? Say the Supreme Court comes out tomorrow and goes, no, you're done, the IEEPA tariffs don't work anymore. Is that an opportunity for him to take the tariff burden down in order to help that group of people into the midterms?
I think it's absolutely an option open to them, as we've seen with the relief on the tariffs on coffee, beef, furniture, etc. And actually, one thing, for instance, a strategy they could pursue, for instance, is the Supreme Court case does not cover the sectoral tariff, the Section 232 tariffs on things like steel, aluminium. So they could up the tariffs on some of those sectors, but they don't have to do as high tariffs as they would that would replace the IEEPA tariff. So I think that's absolutely consideration. And I think that also filters into what's happening around the Fed as well right now, because one of the pressures on the Fed is, of course, to get interest rates down in order that, things like car loans, credit card interest rates, that's a big focus. It's all, you can view it all through the lens of affordability. And I think what has happened is where, in particular, you had those elections last November, where in New York City, in the Virginia and New Jersey gubernatorial races, which the Democrats won across the board, they're now concerned about affordability because that's a political problem.
What do I put in my affordability bucket? Say I believe that story, that Trump wants to win the midterms and he wants to solve the affordability crisis. What's the yesterday it was the staples. The staples got bid yesterday, and that's why the stocks went to a record high. It's odd. What else do I put in my affordability bucket? Is it the staples? Is it what benefits the bottom end of the kind of the socio-economic groups? Is it lower rates? How do I think about that as a package? Because Trump clearly is going to try and push that policy quite hard, and you kind of want to follow the policy.
Yeah, well, I think two areas we've already seen are, one is rates, particularly mortgage rates, which there's been pressure to come down, hence the stuff about the MBS purchases. The other is actually the more prominent aspects of the consumer basket, because not just in the US, but something we saw in Europe, of course, when inflation was surging in 2022, was actually the particularly painful items were stuff like food and energy, the stuff you cannot substitute.
How do I trade that? What's the trade on that?
Well, I mean, actually, staples, like you said, have done pretty well in the last couple of days based on those kind of trades, because actually, if you do something like food, firstly, that's something that everyone has to consume. You can't substitute away from food in the way you can from luxury flights and foreign holidays or shopping on Bond Street, like you mentioned. So, you know, there are risks.
I mentioned, not me.
Well, about yourself.
I mentioned Guy Doss.
So, you know, it's an issue. So, you know, there's that. And then I think, you know, you've got, as you say, that yield curve steepening as well, because if Trump is putting pressure on the Fed to bring down rates, actually the pressure remains. You know, the Fed, indeed, you know, even before the threats on Powell, the dot plot was still saying the Fed planned to cut once this year. So I think the direction of travel for the Fed is still downwards as well. But clearly there's that pressure on the long end, not just because of Fed independence, but also the fiscal stuff.
Just briefly, Henry, do you bet on an overheating US economy then? Because that's one of the risks that you're watching for this year.
Yeah, I think actually my bigger concern, I'm more worried about an overheating US economy than one that goes into recession this year. One thing I'm really struck by is this quarter alone, we have the biggest fiscal impulse of any quarter since the Biden stimulus. And that was in a recessionary context with unemployment at 6 or 7%. So that's coming through from the big, beautiful bill. The Fed have just delivered 175 bips of rate cuts since September 24. That's the fastest pace of rate cuts outside a recession since the 1980s. So you've got this dual monetary and fiscal impulse outside of a recession of the sort we haven't seen in several decades. So my bias is that actually the reacceleration risk is stronger for the US economy right now than the recession risk.
So that's a hike in 2027, isn't it?
I think definitely that's certainly, you know, the probability is that is definitely going up because, you know, I guess the thing you have to then set that against...
You've literally just mapped out a path towards higher rates.
I have, but the risk to that then, as the whole discussion is centred around, is what does Trump do about the Fed? Because in a normal environment, yes, you would absolutely say, given that environment overheating, the Fed are going to want to hike.
But this is not a normal environment.
This is not a normal environment. As Jay Powell himself has said, you know, this is being used as a pretext for lower rates at the Fed, and Trump has made very abundantly clear that whoever is the next Fed chair is going to be, in his words, someone who believes in lower interest rates. So then you're setting up a political battle for 2027. And, of course, it's not just about the chair. We also, January 21st, have the Supreme Court hearing the Lisa Cook case. They're going to be deciding whether she can stay on the board. Her term goes up to 2038 as it stands. So if he can remove Lisa Cook, that could potentially refashion the entire board.
This year looks quite interesting. Henry, nice to see you. Henry Allen, Deutsche Bank research macro strategist. Core 6 looks like this. I'm going to sort of move past this fairly quickly, and we'll get on to Chloe Mele. That's the picture across Europe right now. Chloe, what have you got? Let's start with the wind story.
Yeah, good morning, guys. So as expected, Orsted is moving higher today after a US judge ruled that it could resume work on a wind project off the coast of Rhode Island, which is a project that the Trump administration had suspended. So this is seen as a big win for Orsted in this fight, this ongoing fight against the Trump administration. And so we are up quite strongly. And it's also seen as a big win for that renewable energy space more generally. And so we have got quite positive movement there for Orsted. Moving on to Diageo, which is also on the move today, and it is up about 2.3%. It is said to be considering different options for its Chinese assets, including potential divestments. And this is part of a broader strategy to streamline its portfolio in an attempt for Diageo to kind of move forward as people are starting to drink perhaps less and less. And so we are seeing this potential divestment there being taken quite well by the market. Moving on to ASM International, which is down after Jefferies downgraded that stock, saying that for the semiconductor sector, we will have quite a choppy ride in 2026 because outside of AI, demand remains actually quite weak. And so we are a little bit weaker for that stock this morning. And finally, Symrise, which is a chemicals manufacturer, is up very strongly this morning, about 7%. It is divesting its terpenes division, which is organic compounds found in plants. I didn't know, but now I do. And this is a divestment that is being taken quite warmly by the market. And we're up, as I said, 7% for Symrise.
Every day's a school day, Chloe. Thank you very much. Chloe Mele with the latest on those stocks that we are focused on today. Coming up on the programme, fair winds then for Orsted's Revolution Wind Farm project after that favourable legal ruling in the United States. Fair winds for now. We'll get the broader context on this story next. This is Bloomberg.
Welcome back. You're watching the opening trade, 80 minutes into the equity market session, and I had nothing to say. There you go. Equity markets are up a little bit in some cases and down a little bit in other cases. What that tells you, though, is that below the surface, there are more exciting things happening, and Orsted is certainly one of those stories, Anna.
Yeah, absolutely. Orsted shares are on the move after a US judge ruled the energy giant can resume building a wind farm project off the coast of Rhode Island. Bloomberg's Christian Reinberg is with us from Copenhagen. And Christian, run us through the details then of this ruling and what it means for Orsted, because they still have the bigger legal challenge to go ahead with, don't they? This is just, you can carry on with your work in the meantime.
Yeah, that's true. Well, for Orsted, this particular project is special because it was almost complete when the Trump organization made the stop order before Christmas. Now the judge has ruled that Orsted can continue building, and analysts estimate that it will be a lot harder for the Trump administration to stop this particular project once it starts generating electricity to Rhode Island homes. So there's a bit of a race against time here, where Orsted is presumably eager to start building again very soon, and presumably will be able to generate electricity later this year.
In terms of what happens next, what is the White House indicating in response to this? And can I extrapolate this into other wind farms and other suspensions that have been applied?
Yes, well, so the Trump administration has said, and bear in mind, this is the second time that Orsted has won a legal battle against the Trump administration regarding offshore wind parks. But the Trump administration went out and said yesterday that they will continue to fight offshore wind, and they expect the ultimate victory will be theirs. But and I guess that suggests that we'll see a lot more obstacles coming from the industry. And as you rightly say, there are other developers who have parks that are being challenged by the Trump administration. Orsted has another park in New York, Sunrise. It's not nearly as complete as this one, Revolution in Rhode Island, but the same judge will look at that one also, which bodes well for Orsted. And Equinor, the Norwegian energy giant, also has its park, which is called Empire Wind. That has also been halted. The same judge will also look at that one. The industry is obviously very optimistic about this. You can also see that the Equinor shares are also gaining in Oslo today. So this is a relief for the industry, but it's probably not the end of it when it comes to obstacles put in place by the Trump administration.
OK, potentially more hurdles ahead. 5.6% is the gain for Orsted right now. Bloomberg's Christian Weinberg with the update there. Christian, thank you. Meanwhile, the FT on the banking space reporting this morning that UBS CEO Sergio Ermotti is planning to step down in April of 2027. The Swiss banking chief is preparing to depart at a crucial time for the bank as it fights Swiss government plans to tighten its capital requirements, again, according to the FT. For more on this, let's bring in Bloomberg's Swiss finance reporter Miriam Balazzo. Miriam, what do we know about the reporting? What do we know about the potential decision? What would underpin? Why would Ermotti be looking to step down around this time next year?
And so, hi, Tom. It's actually not so surprising because when Ermotti came back 3 years ago, he did say that he would step down once the integration is through, the integration of Credit Suisse. And he and the bank had always indicated an end of 2026, 27 timeline. So this would be in line with the timing that the bank had indicated. What we had thought, though, was that he would stay a bit longer because of the capital debate that was ongoing with the Swiss government, but this is looking better. This is looking up. So the initial timeline that he had set up is now still on track for 2027. And I think we all we were all taken by surprise that things have gone so quickly since the acquisition, and a lot of things have gone smoothly. So I think this underpins his departure. And now the question is succession. Who can fill up those shoes? We know that the bank is favoring an internal solution, but we're not also overlooking a potential external candidate. But there's a lot of people internally that are lining up for this role, that's for sure.
Miriam, stay with us for just a moment. I want to talk about what's happening with the capital rules, but first I think it's probably worth playing a bit of the conversation that Ermotti had with our Stephen Engel talking about the Swiss banking reform story. So let's just listen to a little bit of that conversation.
We fully understand the necessity of taking the lessons learned from what happened at Credit Suisse. But we believe that the current proposals are not really reflecting what happened at Credit Suisse and are going too far. And therefore, we are contributing in the debate with our views on the matter. But this is now a political process. We hope we're going to get more clarity by the second half of the year.
Second half of the year. Are there compromises that you would potentially accept? And that conditions of doing business, is it a hindrance, obviously, to be still domiciled in Switzerland?
Oh, look, first of all, there is a compromise is usually between two people negotiating something. We are not in a negotiation. It's a political process, and therefore we need to see what's coming out. As I said, our role right now is to make sure, on behalf of our shareholders, our employees, our clients, and in general to the public, that we contribute our views on the matter. But we are a Swiss bank. We are very proud to be a Swiss bank. We believe that is a differentiating factor. We believe this is good for Switzerland, and we want to continue to operate as a Swiss bank going forward.
So it's not necessarily a compromise, because as you said, that would be a negotiation, right? But are you confident that they will come up and there will be a resolution that will be acceptable to UBS?
I cannot be confident about that. I think that I'm pleased to see that there is a political interest to go deeper and fully understand the details of this. It's very important to understand the details of what's going on. So such an important decision cannot be taken out of emotions or by people trying to drive the agenda by fear.
We're getting there. We're not there yet. Maybe we get there. Maybe the skinny on that conversation in terms of the capital story. Miriam's still with us. How close do you think we are to a compromise? Listening to that conversation, are we any closer than we were?
Definitely. I think a lot of positive momentum has been created this past few months. As Ermotti was saying, it is not a negotiation because they are not a part. They can submit their suggestions, their response, which they did yesterday, highlighting the fact that the existing rules the existing proposal jeopardizes the continuation of UBS business model as it stands, and also would impact the Swiss economy as a whole. However, we're seeing a lot of support from the Swiss Banking Association, Swiss Business Lobby, also the leading political party, the SVP here in Switzerland, has also showed its support to UBS and backed that argument that the rules have to be watered down. So there is hope that a compromise could be reached. When this could happen, this is still a question mark, but the next step is to go to the parliament.
Thank you. Thank you very much. Miriam Bellazou joining us there with the latest on UBS. Coming up, we'll take a closer look at the Trump administration's battle with the Fed and discuss wider macro and market themes. This is Bloomberg.
Welcome back. This is the opening trade. We are 30 minutes into your Tuesday session. And yes, there isn't a huge amount of excitement in these markets, the headline level, but we are building on record highs that were notched on European markets and on the S&P 500 yesterday. We'll see if that continues stateside today, of course. Across the benchmark here in Europe, modest gains of 0.1%. Again, given the upside that we saw yesterday, not something to be sniffed at necessarily. Over in Germany, the DAX is adding 16 points. You're a little softer down in France, down 0.2%. And the FTSE 100 in the UK might be flagged lower, currently flatlining essentially for the FTSE 100. Maybe there's a bit of cash on the sidelines ahead of inflation data guy later today out of the US. CPI, of course, in focus, which could be the first clean print that we've seen since, November?
Absolutely. Clean data certainly helps at a confusing time. Let's talk a little bit about what is going on in terms of the internals. 267 up, 317 down. Again, doesn't tell you very much, I don't think, in terms of the nature of what this market it kind of feels like at the moment. Volume's a little off, but not by much. Single stocks, I think there is some interesting stories here as to what is going on. Orsted certainly is one of the standout narratives that we've been watching throughout the morning, winning having a near-term win against the Trump administration. Is it a long-term win? We'll wait and see. But certainly it is being helped out by the fact that a judge has allowed it to continue to build off Rhode Island its wind farm in the near term. That stock is responding quite strongly to that. Santander's up 1.43%. Explain some of the outperformance maybe we're seeing out of Spain. Novo Nordisk is also up. There were some comments, I think, coming through from CEO yesterday relating to the weight loss pills they're now selling into the United States. That seems to be going quite well. Astra, on the other hand, is softer. That's a continuation of a trend. Vinci is one of the reasons why we're seeing the French market down as much as it is. I think that's a downgrade. That is weighing on the French market today. And Sika is also down very, very hard, 7.25%. So within individual stocks, you are getting some movement. Net, what's happening is that actually you're getting a lot of cancelling out. And as a result of which, volatility just remains incredibly low at this point. Anna, over to you.
Guy, let's get an update on some of the other stories we're following this morning. Over to Japan, the yen has dipped deeper into an intervention risk zone after the Japanese Prime Minister Sanae Takaichi's reported plan for a snap election. The Kyodo News reports that Takaichi plans to announce a dissolution of the lower house at the next parliamentary session in a bid to prop up the yen. Former Bank of Japan board member Makoto Sakurai says that the bank may raise its benchmark rate as early as April. President Donald Trump says he is imposing a 25% tariff on goods from countries doing business with Iran. The move ratchets up pressure on the government in Tehran that has been rocked by widespread protests. The announcement also risks derailing the US administration's one-year trade truce with China, which is the world's top buyer of Iranian oil. And the Trump administration's actions against the Fed Chair Jerome Powell have triggered a backlash that could derail the White House's plans to tighten control over the central bank. Fed officials and US senators from both parties have pushed back on the investigation and reiterated the importance of an independent central bank. Senate Majority Leader John Thune said that the threat of a legal battle with the Fed could make confirming Fed nominees, quote, challenging. Something we touched on a little yesterday, Tom, but lives on as a market narrative.
Well, let's get another view on that story and bring in Michael Zizas, Deputy Head of Global Research at Morgan Stanley, joining us around the desk this morning. Fantastic to have you on set with us, Michael. Thanks for joining us.
Yeah, thanks for
Let's
having
start
me.
with, there's a lot we can talk to you about, and so we're really looking forward to this conversation. Let's start with the Fed. How damaging is this for the Central Bank of the United States?
Well, I think we have to see what the end game is first, right? So obviously, it's quite damaging if we were to not have an independent Fed. If we ended up in a situation where the president could effectively choose who the Fed chair is and who is on the board and effectively, therefore, set monetary policy. We're certainly not there yet. And so right now, monetary policy for us is still very much governed by the traditional aspect of how the FOMC is making its decisions, which we think really has kind of shifted, in particular after last week's non-farm payroll report, from being very labor market focused to very inflation focused. And so we still think you're going to have two cuts at the end of this year, or towards the end of this year, really more contingent on inflation starting to come down and that being proof of concept. If the president, however, sort of gets his style of monetary policy more in vogue with his Fed chair or getting the right Fed chair on board, maybe you're going to have more of a permissive attitude around the idea that inflation will come down further. There's a productivity story, and so maybe there's more cuts on top of that. But that's where we think really the debate is right now, the sort of the legality of whether or not the president can actually put the right people on the board. Yeah. That's still TBD. The Supreme Court, the Lisa Cook case, I think that's really the touch point we have to look at.
I mean, to your point, there's a number of different scenarios that could come through on the back of this, but these are extraordinary times.
Sure.
And if we do get the scenario where President Trump is able to reshape this institution in his image, as he's done with other parts of the government, what does that do in terms of your views about the debt and the deficit of the United States
Yeah.
and yields at the long end. I mean, when do we get to a crunch point on that?
Well, and so I would distinguish between reshaping the institution in his image via traditional channels, i.e. getting his appointee as chair, and sort of as more appointees become available, getting people who are more like-minded with their economic view, which would be a little more, hey, we could be dovish because we expect productivity to pick up. That's more sort of traditional channel, and it potentially preserves the independence of the Fed. If you're talking about a situation where the Supreme Court says that the firing of Lisa Cook was justified, and therefore you end up in a sort of close to de facto situation where the president can do what he wants with the Fed, then yes, I think the markets you point to are exactly the shock absorbers you'd look at. You'd look at a substantial steepening on the long end of the curve, the 30-year selling off, the term premium being higher, and the dollar being considerably weaker. You saw some of those trades go in last year in anticipation of this being somewhat higher probability, but there would certainly be more room to run there.
Dollar keep weakening from here?
So again, I'd say
what is the higher probability? Is the higher probability?
I think the higher probability is that we've got some weakening to go on the dollar,
but not much.
But not much. I mean, we were close to 10% down on the dollar last year. But we think we have a little more to go, but you're mostly going to stabilize for the rest of the year.
Okay. Can I put the Fed story into what I'm increasingly calling the affordability bucket?
Yeah.
Trump wants to get everything, the cost of everything down.
Yeah.
Credit cards, groceries, whatever it is, he wants the price down so he can win a midterm election.
Yeah.
How do I trade? What does that basket look like to you? And is that a trade that I can put on, should put on, in and around that policy package into November?
I don't think that there's potentially a trade there, because a lot of these efforts, they're sort of questionable in terms of what the actual fundamental impact is going to be, right? So take, for example, what they're trying to do with bond buying of mortgage bonds, right?
Agency bonds, yeah.
Right. So we are potentially getting mortgage rates down, 30 basis points or so.
Yep.
What our team would say about home price affordability is it's really only going to impact that marginally. So it's not necessarily going to impact that story all that much. To the extent there's a through line from policy to markets, we don't really think it's about affordability. We really think it's about the corporate capital expenditure story and AI in particular.
So not selling banks, buying staples. There isn't that kind of a trade that goes on into the midterm.
I don't think so. However, I think where we'd be wrong is we should pay really close attention to the Supreme Court decision that potentially is going to be delivered tomorrow on the tariffs themselves, right? So if the Supreme Court does strike down the use of these IEEPA tariffs, and the administration were to choose not to reconstitute those tariffs through other legal means, we think they would. But let's say they didn't.
Through the affordability lens, they might not.
Right, exactly. That's a possibility I think we at least have to entertain.
Yeah.
Well, in that case, then you certainly do have all types of consumer goods that all of a sudden the cost of importing those goods comes down, and there should be some give back on inflation there.
Good morning to you, Michael. So we are focused on affordability, but it doesn't necessarily deliver by your analysis, certainly on the mortgage bonds.
Right.
And we could look at other examples of that. Are you concerned about possible overheating in the US economy? We just had a conversation in the last part of the programme with another guest from Deutsche Bank who was saying that that's actually very much on the radar.
Yeah.
So despite the conversation about whether we get rate cuts at the Fed, actually what he's worried about is whether we see overheating in the US.
Right. We are concerned about that. We think it's probably just too early for that story. So take the AI theme, for example. If we think the U.S. is going to spend something in the neighborhood of $3 trillion in AI capex over the next few years, $1.5 trillion of that should be debt funded. That's a lot of debt in the private sector. However, we're starting from a place where corporate balance sheets are quite healthy, debt to EBITDA levels are pretty reasonable, cash to debt levels are quite low. So there's a lot of room to sort of absorb that debt issuance behavior. So we'll have to track that over the course of the year. We think that's going to be potentially the red flag that tells us there's some overheating risk, but we think we're pretty far from that. There's plenty of capacity to make the attempt to spend a lot on capex in the AI race and in the reindustrialization theme.
And what's the unexplored opportunity then in that AI capex build out? Because we've talked about it for a long time. We know the names of the companies that are doing a lot of it and raising that debt and spending their money on it. But where does it go next? What's the next part of that build out for you?
Yeah, I mean, there's lots of ways to answer this question. I think a really interesting way, though, is about how the adopters might be experiencing their own productivity increases. And so our equity strategy team and Mike Wilson's pointed out that if you look down to mid-cap, U.S. mid-cap and U.S. small-cap stocks, you're starting to see earnings growth you haven't seen in the past. Now,
the Russell's had a really good start to the year, hasn't it? Versus
right. So you've had about 8% earnings growth there. It's a swing from being negative 8% a year ago. Now, is this necessarily AI? I wouldn't necessarily put it on that bucket, but it's almost certainly a productivity story. There's probably some deregulation inside of that story. And so I think there are some downstream effects that you're starting to see thematically in mid-cap and small-cap stocks.
Do we put to bed the Mag 7 outperformance story? Is that done?
No, I don't think so, but I do think that a lot of that will hinge on what your view of the AI story will be going forward. And here I'm not smart enough to tell you, right? So the sort of the frontier model builders, particularly within the Mag 7, if they have substantial success in delivering models that show that there's still exponential increases in intelligence there, then yeah, the sort of the potential ROI on that technology is still massive beyond what's priced in. If it starts to slow, then perhaps the adopters are where more of the juice is going to go.
How are you thinking about Europe versus the US in equities?
We prefer the US, but I think the European story is still quite a good one. There is sort of more of a capex story going on there. There's still more of a defense element going on there. So nothing sort of out of the ordinary, I would say, out of consensus. But we do think that the U.S. is still where more of the capex-driven innovation and capex-driven productivity is going to be, and that's ultimately going to flow through the bottom line.
When you talk to clients here, and they go, what's the trade? Kind of, what's mispriced? Where am I? What do I need to do here? What looks obviously wrong to you?
Yeah.
What's the answer to that question?
Yeah. Well, first of all, it depends on the type of investor you're talking about. But if we're just talking about like broad cross-asset purview, one area that we've pointed to as sort of a potential surprise is if you're a credit investor in the U.S., we actually think that high-yield credit is probably going to outperform investment-grade credit this year, which you wouldn't necessarily expect in this environment. But a lot of it is because of the AI theme we were talking about earlier, a lot of the capex that comes along.
Isn't that a run-it-hot economy trade, though? Isn't that? Is that?
That's right. That's right. So it's sort of a technical that's reinforcing a fundamental, right? Yeah. There's more supply coming into the investment grade market. And then, of course, because the economy is doing better than we thought, high yield bonds should actually
When do you want to get out of that trade?
Not this year. Ask me again next year. Yeah.
Okay. And from your perspective, sitting mostly in the States, Michael, I mean, we talk every day about the latest policy coming out of the White House in whether it's, mortgages or the defense sector or all kinds of sectors that fall into the focus of the president. Follow the policy is one of the themes that we've been exploring. I mean, we talked about whether it was the K-shaped economy, not necessarily, you said. I mean, how are you managing to keep a track of that and keep ahead? I mean, you can't be ahead of that kind of thing, can you? Because some of it comes from left field.
Well,
or did you have to just be responsive?
I just say you do, and I don't think there's really. So it's interesting. When we first started very intensely covering the interaction between U.S. policy choices and markets, a lot of times traders and our clients would ask us, give us calendar events for when President Trump's going to announce X, Y, and Z. You're like, well, there is no calendar of events.
No.
It's not.
Wake up at 2 o'clock in the morning and you kind of.
Well, exactly. It's not like the ECO screen on your Bloomberg terminal, right? So some of this is, if you're an emerging market investor, you sort of always implicitly understood, you grew up with the skill set and the knowledge of the intersection between policy choices and markets. U.S. investors are starting to, I think developed market investors writ large, starting to embed this as part of their process.
What does it tell us that they have to do that? And then we have former Treasury secretaries and former chairs of the Fed coming out and saying what we saw over the last 24 hours was very much like emerging markets. Yeah. I mean, what does it tell us that that's the training that is helpful for covering US assets right now?
It tells you that the world is in motion. There's a major secular theme we've been tracking for most of the last 10 years called the shift to a multipolar world, which is not the same as some people say it's like, is the U.S. becoming an emerging market country? That is too reductive a way to think about it. The intersection between policy and markets is just happening more and more and more. And there is a different consensus for policy in the U.S. that it used to be about free trade and government non-intervention. Free trade is now seen, for better or worse, by the American voter as a bug and not a feature. And interventions into the economy are not necessarily dissuaded, right? And that's a view of both the Republican and the Democratic voter. So this is a kind of secular through line that I think investors have become accustomed to, will have to keep becoming accustomed to, even if President Trump's not in office.
But that investing along the lines of a more interventionist U.S. government in the private sector, that is not a short-term, that is a longer-term thing, I think. Because it seems to me that investors are still kind of waking up to that.
Does it come with a discount? Does that imply a discount to assets? Because that is a key question. Are assets in that kind of world less valuable?
Well, it's still what we're talking about is still quite small compared to other countries that have more interventionist policies, right? But sure, if you're talking about the slippery slope argument, but for example, the U.S. government taking a stake in a small mining company, to try and get rare earth minerals out of an Alaska mine, it's still ultimately a very small number.
But telling credit card issuers that they can't put rates above 10% feels slightly different to that.
Sure. And now we're obviously testing the limits of executive power. We'll see where this goes. There have been more guardrails in place that I think people appreciated from the legal system and from Congress. Potentially, Congress is an activity in and of itself. So, I agree that we have to watch the slippery slope carefully, but we shouldn't jump straight to the U.S. as a managed economy.
And it's about passing, as you said earlier, it's about passing the announcement with the real on-the-ground impact as well. Right. Michael, thank you very much indeed. Michael Zisas, Deputy Head of Global Research at Morgan Stanley. Thank you. Coming up, how many jobs is Citi expected to cut this week as CEO Jane Fraser continues her push to trim costs and improve returns at the Wall Street Bank? The answer when we come back. This is Bloomberg. Welcome back. Now, before the break, we asked how many jobs is Citi expected to cut this week. No pleasure taken in announcing this, but it is a fact, so we're going to highlight it for you. The answer is about 1,000 jobs. Bloomberg has learned that the company, of course, which had 227,000 employees at the end of September, is culling its ranks as part of a plan announced 2 years ago to eliminate 20,000 jobs by the end of this year. Streamlining the bank and cutting waste has been a key goal, of course, for the CEO, Jane Fraser, as Citi's performance has long been a laggard compared to other major US lenders. Anna.
Well, the banking sector will be firmly in focus, won't it, today? That'll be one of the things on our agenda. We'll get bank earnings coming up later. We'll also, though, have US CPI data to deal with. We'll have earnings from other parts of the US economy and some Fed speakers to listen to as well. Barkin and Muslim will be speaking. And President Trump will be getting a briefing on Iran, Guy, which, of course, is going to be something that we will be watching. But before that, we get the bank earnings story in focus.
We're going to watch that very, very carefully. I'm looking forward to hearing what Jamie Dimon and others have to say on what is happening with the credit card business. Wall Street, biggest banks kicking off earnings season. Expectations of near record profits are certainly being buffeted by what is happening around the layoff story, which kind of normally comes around this time of the year, and potential policy changes out of Washington. How do we fold it all together? Well, the way we fold it all together is we're going to talk to Charlie Wells. He's here with the latest.
Guy, that's exactly right. And I mean, we are hearing a lot of turbulence in the banking sector this week, a lot of short-term turbulence, I would say, thinking about some of these policy ideas coming from Washington, not sure how those will factor out. But when you zoom out from this week, when you look at that past year, you see the strength of that KWI index, those major lenders outperforming the broader market, a lot of optimism in the market about these banks and strong fundamentals. And one of the most fundamental themes that we are going to hear about, no doubt, as these banks start to report is deal flow. We have seen in 2025 the best year for deals since 2021, that record-setting year from 2021 really manifesting these green shoots that investment bankers had been talking about for years since that time, finally coming to fruition in 2025. What happens when you get that deal flow? You get investment banking fees clipped from there. You can see that to the tune of almost $10 billion at some of these major banks. We're really seeing JPMorgan, a leader here, Goldman Sachs. So this is a theme that, despite some of this short-term turbulence that we've been hearing, is really going to come out loud and clear today.
OK, the art of all those deals and fee generation then in focus. And certainly those will be in focus then when we hear from the first US bank to report this week, which is JPMorgan. Charlie, that report dropping on the Bloomberg terminal later today. So how are analysts expecting America's largest lender to perform?
Look, so there's one number that's really jumping out from Fortress Diamond this morning to me, and it is this growth in equities trading. We're seeing growth of over 31% in the quarter. That is, of course, because there has been a lot of volatility in the market that investors have wanted to reposition, and trading desks have been able to take advantage of that. So you see some of, the investment banking activity boosting these banks. You also see it boosting these trading desks. But of course, there also is this theme of growing loan loan growth in this environment where we are seeing the potential for lower capital requirements. You are seeing some of these major banks, and JPMorgan really has taken leadership here, growing their loan books. So the fastest growth in loan books since 2010. So we're winding back some 15 years there. But I've got to say, risks remain. And I think getting complacent is the issue that we are seeing that this morning could not be beneficial to investors. And some of the risks here, surprises on expenses. We saw when JPMorgan talked about expenses last month, that really hitting their shares. You could see some commentary, some forward-looking commentary on potential momentum coming out of that AI boom, coming out of this M&A momentum, and also that macro uncertainty that we just see in the market right now.
Charlie, great stuff. Thank you very much indeed. Charlie Wells on the banks. Talking of macro uncertainty, let's talk about what we could get when it comes to the CPI number a little bit later on. Scarlett's back to talk us through what the market is looking for on this number out of the United States. Upside risk?
Yeah, I mean, the issue is you have conflicting factors, right? So I think it's very hard for this to be a dovish print because we had strong employment last week. We know the Fed is looking more at the employment mandate than the inflation mandate. And so that tells you that it's a relatively hard bar to be dovish. I think the other thing to consider is when we got the November and December data, November and October data, it was a big surprise to the downside because it was distorted by the shutdown. So if you have a weak print, you just go, oh, well, maybe it's just still distorted. And but on the other side of it, you have consensus expectations are for a hotter
print.
print.
So if it's not strong, I can ignore it, basically.
Yeah, I think that's largely the message. And I think the issue is if it is strong, your 10-year yield is at the top of the range. So is that enough to have it break out? Probably not. You probably need a series of hot prints, or more likely, you need to see a reacceleration in growth.
What's more important, is it the inflation data or is it anything else on the Fed? It was interesting to hear from Michael Zizas of Morgan Stanley a few minutes ago, and he said what he would be watching for potentially to be more concerned about the Fed would be a Supreme Court ruling in favour of the Trump administration on Lisa Cook. What would you be watching for on that front?
Yeah, I mean, absolutely. That is something that I would be very concerned about the Fed from, in terms of that sets the precedent that you can get rid of Fed governors, and that means you could have a broad turnover. Because what's stopping you from having the loss of Fed independence now is the fact that you have many members that vote. There isn't a big turnover this year. Stephen Moran's position is potentially turning over. We don't know whether or not Powell's resigning. So that's a maximum of 2 unless you're able to turn over these other positions. And because of that, you can't skew the vote count to having more cuts priced in or more cuts than what the market thinks is reasonably priced in. So I think certainly if we had that turnover, it's something to think about. But I think the bar for it is relatively low, which is why the market's not pricing it or looking at it super closely.
Okay.
You see, Skylar's maybe not remotely interested in CPI now. So, you know, everything else seemed very fascinating, but you didn't seem too moved by the CPI.
Guy was very happy that Skylar wasn't excited by CPI.
Can you get out of the 10-year range that it's been in? I think it's,
and if it doesn't, if it's not hot and it doesn't do that, then move on. Move on to more Fed narrative.
I don't know what's more important. Is it the Guy tin can trade or is it the Takaichi trade over in Japan?
The tin can trade
still has legs.
Yeah.
This is the staple
Wall
story.
Street prepping story, I think, is one to watch for. Though Michael Zizas was completely downplaying that. He's not into tin cans. But Takaichi's going to be interesting. That ripples into other markets. Is that going to be enough to get us out of the 10-year? I don't know. Lots of things to get us out of the 10-year range, maybe.
Lots of questions. In the midst of all of that, what do we think about the healthcare sector and what it's doing? We're going to be hearing from the JPMorgan Healthcare Conference later on today. The Novo Nordisk CEO, the Roche CFO, the AstraZeneca CFO, all of those voices speaking to Bloomberg. So lots to come on that sector. That's it for the opening trade. Busy morning. The Pulse is up next. This is Bloomberg.